Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update on Mako Mining, traded on the TSX.V under the ticker MKO, and also traded on the OTCQX under the ticker MAKOF. And we are joined today with the president and CEO of Mako Mining, Akiba Leisman. And Akiba, it's great to have you on the show again to get an update on Mako Mining. Mako Mining runs and operates the San Albino Mine in Nicaragua and has a number of exploration licenses and concessions around the San Albino Mine, as well as Las Conchitas and a number of regional targets, and is also in the process of acquiring gold source mines. And there's a lot of news flow from the company, but more recently you've had a couple press releases out, Akiba, that just dealt with some of the disclosures. I thought it might be nice to give you the opportunity to just unpack that for investors listening in.
Sure. So these two press releases, which were, I guess, a few weeks apart, were all related from the same inquiry that we got from the British Columbia Securities Commission about some of our disclosure that we've had in the marketplace. And then, as I put in the press release from yesterday evening, is that there's nothing wrong with the resource. We've been positively reconciling by about 20%, and that's inclusive of inferred ounces. In fact, 71% of the ounces that we've actually mined since the effective date of the report have been in the inferred category. And I'll go over what the implications of that actually mean. But the two layers of inquiries that they had was one that was completely our fault, right? So we've used an external qualified person named John Kowalczyk going back since 2009. So even before my time, I think we've counted that he's QP'd 75 press releases for us over the last 15 or so years. And then John, who's retired, wound up forgetting to take an online correspondence course last year. So his QP registration expired in January of this year. So the BCSC pointed out that our last two exploration updates did not have a qualified person. So we reissued those two press releases with the same technical data, but using Dr. Matt Gray as the QP of there. So mea culpa, that one was on us. We fixed that disclosure from 2.5 or 3 weeks ago. Then the other line of inquiry that they had was a little bit of a frustrating exercise from my perspective, because this was not a technical oversight on us. And it all comes back to this gray area that Mako Mining operates in. So there used to be a PEA on the project back in 2015, and I've been pretty open with your listeners that I thought that that PEA was BS, right? So I don't think that the data that went into the geological model was accurate or predictive, and certainly the economics associated with that PEA was not worth the paper that it was written on. In fact, I've been pretty public with some of the people that were there signing off on that, where I just don't think it was good professional behavior for them to do that back when that PEA was issued in 2015, which is kind of like one of the origin stories about why Mako exists when the predecessor company Golden Rain put out what we consider to be shoddy technical data. So back when we did in 2020, we took the approach of making sure that we had a detailed understanding of our geological model, develop economic mine plans around that, get the mine into production, get the mine into cash flow, and then use the cash flow associated with the mine and profitability associated with the mine to go and crack the code of not only our current deposits, but also the potential exploration opportunities across our 188 square kilometer land package. Like I will always say, the decision that we made to do that was the correct one. In fact, this would not have been a success had we not taken that approach. But the issue when it comes to the disclosure on doing that is that obviously we don't have reserves, number one. And then number two is that because we don't actually have an economic study, we kind of fall into this hybrid situation where for NI 43101 regulatory requirements, there's something called an advanced property. So what an advanced property basically means is that, do you have a resource or a reserve that is backed up by an economic study? So do you have a reserve that's backed up by a pre-feasibility or feasibility study, or do you have a resource that's backed up by a preliminary economic assessment, which Mako does not have? So we would explicitly not be considered to be an advanced property under those scenarios. But we've been in production, right? We've been in commercial production since July of 2021. It's entirely reasonable to take the view that we are an advanced property versus not, even though we don't meet the explicit definition of this. Now, the practical implication about what that decision process actually means is that if you're an advanced property, you have to file these 7 sections within a 43-101 report. If you're not an advanced property, you don't. We knew that there was ambiguity associated with this. So prior to us filing that amended resource statement back in 2023, we actually called up the BCSC and asked them anonymously. They didn't know that it was Mako, but we did lay out the facts on what was going on the ground. And what they said was, or the guidance that they provided was, you don't need to file these sections because you're not an advanced property. So we decided to file on the back of that guidance. And then as part of this disclosure review, there was an inquiry as to why we didn't have these 7 sections in our report. We didn't have the 7 sections in the report because the guidance provided last year said that we shouldn't do that. So we said, fine, we'll put these sections into the report. Now, the practical implication for this and why this became kind of like a little bit of a crisis within the company, it had nothing to do with anything from an operational perspective. In fact, we put in this press release that the mine has been positively reconciling to the resource model by over 20%. So the resource has always been conservative and pristine. But why this became somewhat of a crisis is that we're in the middle of a merger agreement with another company called Gold Source Mines. And then they had their shareholder vote originally scheduled for effectively today, like Friday the 14th. Now, their management circular was referencing our technical documents. And if there needed to be adjustments to those technical documents, all shareholders need to be aware of any technical disclosure. So invariably, this was going to have to delay the vote. So at the time when we submitted the amended report to the BCSC, we knew that the vote would needed to be extended by 7 to 14 days, which Gold Source has. The current vote count is 97% in favor, so I don't actually think this is actually going to affect the outcome of the vote. But you never really want to be in a situation where things like this get delayed. But that was kind of the main rationale for the disclosure review. And then just lastly about this, and really, I think kind of like the root cause, and by the way, none of the actual decision processes of the BCSC were wrong. I mean, everything that they're saying is completely rational in terms of where we are. I mean, we're a little bit frustrated that we actually approached them for guidance, but it's not like, oh, Mako Mining, there's no way that we're an advanced property because it clearly says that in English that we're not. We get there's ambiguity over there. But the root cause on kind of like the disclosure review in the first place is that, as you are fully aware, I've been very careful about not providing forward guidance on how what our production is going to be in the out years over there. The way that 43-101 was set up, as you may be aware, it was after the BRIEX scandal in 94, and they basically wanted to make sure that pre-production and pre-development companies in general don't have the ability to lie about their information. That's kind of why it's kind of set up that way. So there's this framework in place where before you actually say what you're going to do, you really should have reserves over at your deposit before you can start talking about things that are going to be in the future. That's why there's a lot of sensitivity about the word or, for instance, O-R-E. If you don't have reserves, you can't say that you have ore. If you don't have reserves, you can't say about how the mine is going to be behaving in the next 2 or 3 years. And we've always been very careful about that. But the root cause as to why we don't have reserves for our property is that when we develop our resource model, everything that we do, measured, indicated, inferred, all show up in our mine plan. And this was really a decision that we made back in 2020 that we weren't like, I don't think we were fully aware of all the ramifications that this would have created back then. But we took a very specific definition to what our inferred category of resource are. And I say it has something to do with drill spacing. But really with our deposit and the complexity of our deposit, there's 2 other things that wind up placing ounces into the inferred category. One is if more than 50% of the data is coming from trenching results. Now, as you know, we have a very shallow ore body. Sometimes it's not practical to be drilling drill holes that are 5 or 6 meters deep. So a lot of the information that you get from some of the shallow parts of our ore body are coming from the trench results. And then secondarily, a lot of our inferred ounces are coming from areas where we do have certainty about whether or not those ounces exist, but we don't have certainty on their spatial positioning. So sometimes around faults, sometimes just because the way the thrust fault system of our deposit works, it kind of smushes things up. So you can have ounces that wind up showing up 5 meters away from one another. It's not an unusual event for that to happen. So all of those ounces come into the inferred category. And as you may be aware, is that you can't convert inferred ounces into the reserve category. You only convert measured and indicated ounces into that. So when we have certainty on where those ounces exist, almost by definition, we can't put them into the reserve category, even though our mine plans are based around that. So if we ever want to declare reserves on our property, the only way for us to do that is to basically eliminate the inferred ounces and create mine plans, which are what we are not doing at the operation. So it basically, in order for us to disclose reserves, we would have to disclose a mine plan that isn't real and it's not reality, which is something that we don't do, is that we take a very, very strong view on our technical data, and we want to make sure that our technical data is reflective of reality. And by that definition, it becomes very, very difficult for a deposit of this level of complexity to issue reserves on that basis.
Well, Akiba, I appreciate you breaking it down for us. It makes a little more sense when you look at the disclosures, why all those processes are in place. The NI 43-101 are good standards for everybody to have. There is a little bit of, like you say, that gray area because you're an operating mine and you're using the trenching at near surface and you're using the inferred ounces in the mine plan. So I think the best thing to do is just to deal in the real and look at how the quarterly performance is going. You just had some news out on May 21st recapping the Q1 operations. I think most people listening that are investors in the company or thinking about it are just looking at what is the mine actually doing? What are you actually finding with exploration? But then also, when the rubber meets the road, how is this mine performing? Why don't you break down some of the key metrics from the Q1 operations as to how Mako Mining is doing in Nicaragua?
Sure. So going back to Q4, that was a record quarter in terms of gold ounces recovered and gold ounces sold. So we wound up recovering about 11,500 ounces, 11,400 ounces of gold in Q4, and wound up selling over 13,000 ounces for gold because we had a Q3 2023 refinery shipment that got pushed into Q4. I would consider Q1 to be a more normalized quarter. So there was definitely some tailwinds in Q4 that aren't repeatable. So what we did in Q1 was we recovered almost exactly 10,000 ounces of gold equivalents. Because of the Easter holiday, we wound up shipping our last shipment maybe 5 or 6 days before quarter end. So we wound up only selling like about 9,300 ounces of gold, which affects our declared AISC. So that's why you saw AISC a little bit above 1,000 an ounce, but it's still an extremely profitable quarter. So we wound up generating $5.3 million of net income for the quarter. That was after we generated about $9.5 million of net income for Q4. And then in terms of what's going on with Q2, it's like we're going to be pretty close. In fact, as part of this disclosure press release, we did put out how much gold ounces we've sold in part. We have to do some back calculations to figure that out, but in part on what we did in the first 2 months of Q2, and you can see that we're on track for what it's going to be close. So it's not going to be like a blowout record of a quarter, but it's going to be like pretty close to plus or minus a few percent of that record recovered ounce that we have in Q4. The main difference between this quarter versus Q4 is that we're dealing with gold prices that are nearly 20% higher, 15-20% higher. So the mine right now has never been this profitable. Like our cash balance is increasing by a lot and allows us a lot of flexibility to deal with anything that comes along the way, and inclusive of taking on a development project like we're acquiring over at Gold Source Mines.
Well, Akiba, I want to dig into some of the metrics here just because, over the last 6 months, the mine has averaged about a $917 per ounce AISC. So even with this higher amount, 1,043, when you think about the spread between where gold prices are right now at 2,300, I would imagine that Q2 is going pretty well. But when you look at a lot of the majors, they have cost creep up in the 1,300, 1,400. I'm seeing some of the even $1,500 and $1,600 an ounce AISC. So in comparison, these are really fat margins. Maybe just speak to how the grade plays into this as far as being such a high grade open pit deposit and how that keeps the cost down and anything else that's keeping the cost at a really good margin spread for the company.
Well, sure. I mean, the grade is everything and I think it's somewhat analogous to some of the majors that you're talking about as well. When you're dealing with a super high grade deposit like ours, and as your viewers may be aware, like the average vein that we have is carrying about 17 grams a ton. The diluted grade is probably somewhere in the neighborhood of, since inception, 13 grams a ton, and then we blend that with lower grade material, such that the average head grades are like 7.5 to 8 grams a ton. So in Q4, we were mining this at about 8.5 grams. In Q1, we were milling this at about 7.5 grams. In Q2, it'll be more like Q4 in terms of grades. So all of that falls into play. Like I really haven't seen, we had some pretty substantial inflation responses to our consumables maybe a year and a half ago, up to about a year ago. Those have stabilized. So now you're dealing with unit costs that are pretty stable. Now, sometimes when we're dealing with new deposits, we have to be cognizant of how far the waste is getting moved. That actually adds to cost. So we have to be very nimble about where we place our waste dumps. Like effectively from a mining perspective, this is like a waste moving exercise more than an actual quote unquote ore moving exercise. So that doesn't really affect costs. Now, going back to the majors, and one of the differences between our deposit is that our mine plans and our sensitivity to gold price in general isn't really there. So we would mine the same way if gold prices were at $1,300 gold, and we would mine the same way if it was at $3,000 gold, which is good and bad. There's some investors that actually really want to have like leverage to higher gold prices. This is a deposit where there's going to have like baseline profitability, and obviously higher gold prices are good because higher gold prices we sell for more, we generate more profits. But what I think a lot of the majors are doing is that as gold prices go up, they can bring a lot more what would have been sub-economic material in lower gold price environments into their mine plans and then mine it profitably. So it's not a surprise to see the majors AISC kind of cost creep go up, even in a relatively stable inflationary environment. For us, it's always going to be kind of like stable, and it really is going to depending on grade, and that's kind of why grade is really the main flex. There's always going to be variability on where we are on the deposit. You should never expect a 17-gram high-grade narrow vein quote unquote ore body having a flat line, no variability type grade. So sometimes they're going to be lower, sometimes they're going to be higher, but it's not really going to be changing how we're going to be operating. And then unless we have events like what happened in 2022 with rapid inflation, really our costs are more or less going to be pretty stable as well.
And I think most people can do the math and just figure out, let's just say you're roughly between 950 and 1050 on the AISC, whatever gold price does, whether it goes up or down, to 2,000 or up to 3,000, whatever it does, you've got some pretty fat margins to then plow back into exploration to use that in a way as an ATM machine for the company to focus on growth, not just on exploration, but also development. And then as things go with gold source mines, eventually putting some of that work into Eagle Mountain. But just on the exploration side, I think a lot of people fail to see how much work you're doing in the background on exploration, both with Diamond Drill, but also with RC, just for your mine plan. So maybe just speak to the exploration side of the business, using these fat margins to continue to grow.
No, sure. So part of the exploration has been allocated to infill work because we have an operating mine. We have an operating mine that, as I mentioned earlier, has a lot of inferred ounces in its mine model. So we want to make sure that the spacing is good and available for not only predictiveness of our model, but we also have pretty extensive blending protocols for metallurgical purposes. So making sure that we have very detailed plans on what's coming out of the ground is essential for us. So we've had a rig that's been focused on infill work. And then the other RC rigs, and it's almost exclusively RC right now, are there to do near mine new areas of discovery, right? So within the Las Conchitas area, within somewhere just to the north of San Albino, and that next objective is to bring out additional ounces that can eventually come into an economic mine plan over the course of the next, let's call it 2 to 3 years. And then what I would really like to do, and just because there's so much work that needs to be done over the site, and by the way, all of this is getting like obviously funded from operating cash flow. I think like don't lose sight of the fact that the last time that this company raised equity was almost exactly 4 years ago. The last time this company has raised any net capital of any type was in February of 2021. Since that time, we've wound up repaying, I think, 19 million of the $21.5 million of debt that was outstanding on the balance sheet. Since that time, we've also repurchased probably another $6 million worth of stock as well over the course of those few years. So the mine not only has been able to generate exploration investments, it's not only been there to increase our purchases of surface rights to make sure that we have the flexibility on where we're going to be mining, but it's also been there to basically cleanse the balance sheet and make this a very, very clean, conservative, profitable by every financial metric that you can look at company that puts us into a position to acquire new deposits, new projects, like we have over at Eagle Mountain.
All right, I think it's an interesting picture here coming together of not just the operation side, but the exploration side, obviously also growing not just organically, but also through an acquisition. So a lot going on with Mako Mining. And if people listening in want to follow along with the news at Mako Mining, definitely click on the link below this interview. It takes you over to the company news section. And Akiba, I know there's probably a lot more news to come, so it's going to be a busy year for the company. Keep me posted. We'll get you back on for an update and looking forward to our next conversation.
All right, great. I appreciate it, Chad.